Let's get oriented. I'm Lázaro Ulloa, owner and founder of Ulloa Financial, and this is your market compass for the week ahead for Monday, June 29th, 2026. Markets enter the final days of June with investors asking one central question. Is this simply a temporary reset within an otherwise resilient bull market, or is the market beginning to question the assumptions that carried it higher earlier this year? Last week gave us three important signals. First, technology leadership weekend, particularly among artificial intelligence related companies and semiconductor stocks. Second, inflation remains too persistent for the Federal Reserve to declare victory. And third, energy prices eased as oil markets began pricing stabilization in the Strait of Hormuz following reduced concerns over immediate supply disruptions. That combination matters. Lower oil prices can help improve inflation expectations. Lower inflation expectations can ease pressure on Treasury yields, and lower Treasury yields can support higher stock valuations. But if investors remain confident that corporate earnings will continue growing, that brings us to this week's central theme. Stabilization is not normalization. Markets may be calmer than they were earlier this month, but calmer does not mean risk has disappeared. Last week, the broader market softened as AI and semiconductor stocks came under pressure. The S&P 500 and Nasdaq both finished the week lower, with the Nasdaq experiencing the larger decline because of its heavier concentration on technology. Meanwhile, the Dow Jones Industrial Average held up considerably better as investors rotated into more defensive sectors. Healthcare, utilities, and consumer staples outperformed, while many of the year's biggest technology winners gave back part of their recent gains. That distinction is important. The market wasn't selling everything. The market was rotating. Investors weren't abandoning equities altogether. They were becoming more selective. That often happens when a dominant investment theme begins facing higher expectations. Earlier this year, enthusiasm surrounding artificial intelligence helped push technology valuations significantly higher as investors anticipated enormous productivity gains and long-term earnings growth. Last week, however, the market began asking a more difficult question. How much future growth has already been priced into today's valuations? When expectations become elevated, simply delivering good results is no longer enough. Markets begin demanding exceptional earnings, expanding profit margins, and continued evidence that massive AI investments will translate into sustainable long-term profitability. The bond market also reflected a more balanced tone. The 10-year Treasury finished the week near 4.5%, while the 2-year Treasury ended near just over 4%. That tells us investors continue balancing two competing forces. Sticky inflation argues for higher yields. Slowing growth and increased markets uncertainty encourage investors to buy bonds, putting downward pressure on yields. One particularly interesting development is the shape of the yield curve. For much of the past 2 years, short-term Treasury yields remained above long-term Treasury yields, creating what is known as an inverted yield curve, historically considered one of the more reliable recession indicators. Today, the 10-year Treasury is once again yielding slightly more than the 2-year Treasury. While one indicator alone never predicts the future, the return to a positive yield curve represents another example of stabilization, replacing some of the recession fears that dominated financial markets over the past several years. Again, stabilization is not normalization. It simply tells us that the markets are beginning to reassess recession probabilities. Inflation also remained a major story last week. The latest PCE expenditures report reminded investors why the Federal Reserve is not yet prepared to relax monetary policy. While headline PCE remain elevated, core PCE, which excludes the more volatile food and energy categories, is running around 3.4%, its highest level since 2023, and still well above the Federal Reserve's long-term 2% inflation objective. That reinforces why policymakers continue describing their approach as patient and data dependent, rather than preparing investors for near-term interest rate cuts. Even though lower oil prices provided some welcome relief, energy is only one component of inflation. Services inflation, housing costs, wage growth, and consumer demand continue influencing the broader inflation picture. The inflation story is improving, but it's not finished. Oil prices moved lower as additional tanker traffic resumed through the Strait of Hormuz, and markets assigned a lower probability to an immediate disruption in global energy supplies. Brent crude settled back into the low $70 per barrel range after spiking earlier in the month. That helped improve investor sentiment. Lower oil prices can reduce transportation costs. Lower transportation costs can reduce inflation pressure, and lower inflation pressure can improve both consumer confidence and corporate profit margins. But once again, we must distinguish between stabilization and normalization. If shipping lanes remain open for several weeks, markets will likely continue pricing stabilization. Normalization would require sustained geopolitical calm, predictable shipping patterns, lower insurance costs, and energy markets that no longer react sharply to every new headline. We're not there yet. Consumer sentiment also improved modestly during June, helped by the easing gasoline prices and reduced concerns over an immediate regional conflict. Even so, confidence remains historically subdued as households continue adjusting to higher prices for groceries, for insurance, housing, and everyday necessities. Markets often respond to expectations. Consumers respond to reality. Understanding that distinction helps explain why markets and Main Street don't always tell the same story. This brings us to the current market thesis. The market continues operating under the assumption of a soft landing, but that outcome depends upon several important conditions remaining intact. Inflation must continue trending lower. The labor market must cool gradually without breaking. Corporate earnings must remain resilient. Energy prices must stay relatively contained, and the Federal Reserve must remain confident enough to avoid additional tightening while resisting pressure to ease too quickly. That is a very narrow path. It doesn't mean markets cannot continue moving higher. It simply means investors should recognize exactly what the market is assuming. One of the most important lessons among long-term investors can learn is this: market expectations are not the same as actual economic conditions. Markets are forward-looking. They continuously price what investors believe is likely to happen over the next 6 to 12 months. Economic data tells us where we've been. Markets tell us what investors expect next. Right now, markets are pricing stabilization. They are not yet pricing complete normalization. Now, let's look ahead to this week before us right now. Although this week's economic calendar is lighter than some recent weeks, several reports still deserve close attention. Today, investors received the Dallas Federal Reserve Manufacturing Survey. This offers insight into manufacturing activity within one of the country's largest industrial and energy producing regions. Tuesday brings consumer confidence and JOLTS job opening report. Consumer confidence remains important because household spending continues to drive nearly 70% of the U.S. economy. If confidence improves, investors may interpret that as continued support for economic growth. If confidence weakens unexpectedly, markets may begin questioning whether consumers are becoming more cautious. JOLTS provides another important measure of labor demand. If job openings remain elevated, the Federal Reserve may conclude labor demands remain too strong to comfortably bring inflation lower. If openings continue cooling gradually, that supports the soft landing narrative. A sudden deterioration, however, could raise concerns that hiring conditions are weakening faster than anticipated. Jobless claims also remain worth watching because they provide one of the timeliest indicators of labor market stress. Housing continues facing challenges from elevated mortgage rates, which affect affordability, construction activity, consumer confidence, and local economies. This week also marks the beginning of another important earnings session preparation period as investors begin positioning ahead of second quarter corporate results. The best case scenario this week would include stable labor data, steady consumer confidence, contained oil prices, and no significant geopolitical escalation. The downside risks include renewed weakness in technology, unexpected labor market deterioration, or geopolitical developments that once again push energy prices higher. Now let's turn to geopolitics. The Middle East remains one of the most important geopolitical risks facing financial markets because of its direct relationship to global energy supplies. The Strait of Hormuz remains one of the world's most strategically significant shipping routes. And here's why investors should care. Geopolitical conflict influences energy prices, which influence inflation, which influences treasury yields, which influences market valuations. That transmission mechanism explains why geopolitical events can quickly affect investment portfolios, even when the conflict itself occurs thousands of miles away. Russia and Ukraine also remain economically relevant because continued attacks on energy infrastructure influence fuel markets, refining capacity, and global commodity prices. While China and Taiwan remain a long-term strategic concern because Taiwan continues serving as one of the world's most important semiconductor manufacturing centers. Any disruption there could significantly affect global technology supply chains. Investors don't need to react emotionally to every headline. They simply need to understand which headlines have the potential to travel through the financial system. So what does this mean for you, the investor? For investors with a higher risk tolerance, this remains a period to be selective rather than aggressive. Long-term opportunities often emerge during periods of volatility, but discipline remains essential when valuations are already elevated. Pay particular attention to market breadth. If weakness remains concentrated within technology while other sectors remain healthy, that suggests a normal sector rotation. If weaknesses begin spreading broadly across industries, that deserves closer attention. For investors with a lower risk tolerance, continue emphasizing balance, quality, liquidity, and diversification. Today's higher interest rates have once again made high-quality fixed income and cash alternatives meaningful components of many portfolios. But remember, lower risk never means no risk. Inflation risk, reinvestment risk, and concentration risk still deserve careful consideration. Ultimately, successful investing isn't about predicting next week's headlines. It's about building a financial plan capable of withstanding multiple possible outcomes. Know your time horizon. Know your liquidity needs. Know why you own each investment. And don't allow short-term volatility to derail long-term goals. One final reminder. Markets often move faster than the economy itself. Stock prices reflect expectations about the future. Economic reports describe where we've already been. That's why markets sometimes rally during difficult economic headlines, and sometimes decline during otherwise healthy economic conditions. Successful long-term investing requires understanding that difference. So here's what I'm watching this week. Whether technology stabilizes or continues placing pressure on the broader market. Second, whether this week's labor data continues supporting the soft landing narrative or begins challenging it. Third, whether lower oil prices can hold or whether renewed geopolitical tensions bring energy and inflation back into the spotlight. The market is not broken, but it is being tested. And when markets are tested, discipline matters more than emotion. Stay focused, stay disciplined, and as always, stay oriented and elevate your legacy.